everybody. How are we all doing? Morning, Forex. Fire, Danny, Evil, Jules. Good morning, good evening, good night, etc. Morning, Youssef. How are we doing? So today, I don't know how many's in here. Say hello, everybody that's in here, so I know how many's in here. Morning, Rodrigo. So today, nothing really scheduled. So we've had price action week this week, and we've covered everything pretty much in price action that I know. You've got it all. There's not much else to it, to be honest. Price either goes up, it goes down, and the candlesticks tell you whether it was bullish, bearish, or an indecision. That's pretty much it. And we've learned how to put them together to make price action candlestick patterns. Yeah, and that's pretty much it. Morning, Linus. Evil, if I remember correctly, a few weeks ago you were talking about reevaluating your ADR values from 10 to 60 to smooth out changes. Did you do some research on this? And it's still going on. Yeah, so I did do some research on this. We can cover that. I was going to do a session on it, but I'm just looking for the spreadsheet. There it is. Is that it? Yeah, it is. We'll look at that in a minute. And I have actually on my VPS switched to ADR 60. He says, thinking, has he switched to ADR 60? I think I did. Yes, so I'm using ADR 60 now. So yeah, we'll look at that actually as well today. That's a good thing to look at. And why. But yeah, so we've done all the price action stuff. So today's really a case of just Q&A stuff. We're going to have a look at this strategy that Alexander came up with, which was the buy on a Monday index strategy, which I put the EA out in the member section for, and look at the results for that, which were those. And I wanted to do a little bit of testing on Harold's system, potentially, and some price action trading, because I've got the price action toolkit set up ready to do some price action trading. But as I kind of said, trading price action is about sitting on your hands. That's a good looking short. I'm a little bit late on it. Very late on it, to be honest, but we'll see. Yeah, so hopefully it's clear why I've taken that trade. If it's not, let's explain it. We've got an intraday resistance there, there, and there. We have two long wicks. We have a bearish engulfing. We have a rejection at resistance, which is clear, and bears taking control of the market. This will either work or it won't. There's a good one, wasn't it? Most of it's sitting on your hands until you see something that looks good. That looks good. Whether it works or not has got nothing to do with the fact that I've just seen this, because what happens next is entirely down to the market. But there is a high probability of that potentially dropping, because there is rejection at a previous level we've had rejection at, and we have the bears taking control and obvious exhaustion wicks to the upside. Price action, that's all it is. Whether it works or not, down to the banks. But that's all price reading price action is, basically, is we've got a lower low, a lower high, we've got a bearish engulfing, we've got wick rejection at resistance. Take the trade. That's all you can do, basically. So we'll see how that plays out. Probably be a loss. So yeah, let's start off then today. So anybody got any questions on what we've covered this week or last week, or any questions in general? Obviously, just feel free to fire away. If you're watching this on replay, obviously use the comment section below or use Discord. So I'm going to start off with this strategy because it's fairly straightforward. This strategy that we looked at and that I built the EA on is basically the buy on Monday strategy. Yeah. So all that it's doing is we're looking at the indices, and if on Monday the close is lower than the close of the Friday before, you press the buy button, and you then get out when the price closes above the previous day's high. So in this case, price closed above the previous day's high. So the trade would be entered there, and in fact, it would have closed it there, wouldn't it? It would have closed it there. Yeah, that's what it does. If the trade doesn't manage to get that exit criteria, it basically closes on a Friday with whatever the loss is. Yeah. So I did that test, and I built this EA to test it, which is not in here. Why did I put that? I put it in here, didn't I? And I haven't. This account hasn't got indices. Let me do it in here. There we go. Monday close. Yeah. So the EA that I built, basically all I did was put a lot size in there. Time to close trades, which has to be, I would always recommend closing your trades before the end of the day. Usually give it quarter of an hour, half an hour, so that you don't get possible huge spreads. So it was, the original strategy didn't have that. Close if in profit, basically. So it was close trades on Friday regardless of the result. If today's close is above yesterday's high, close the trade. And the only rule is if on the Monday the close is lower than Friday's, go long. That's it. That is the strategy. It's really, really easy. So that strategy there, I tested on a number of different indices to see what the results were. And I used a 30-minute time frame. You can use open prices for the test. So let me just run a test and see if we get a trade. Didn't get one there. Let me just quickly whiz through a little bit. Is that it? What happened there? Oh, it's still going. There we go. All right. There you go. So there's a buy, right? So this is Monday. There's your close on Monday. There's the close on Friday. It's lower, so it bought it. Now what we're waiting for is the market to close above the high of the previous day, and then it will close the trade out. So let's let this one run out and see what happens, just to explain the strategy. And if we get to Friday and it hasn't done that, it goes, oh, well, didn't work. Ha, that was lucky, wasn't it? So on the Friday, it decided actually to close above the high, but regardless, it would have closed there anyway. But there you go. So that's the strategy. And the whole idea of it is, it's called the turnaround Tuesday, is that if we open on a Monday lower than the Friday, it will usually reverse. This strategy is kind of logical, but it also has this weird thing where, you know, why buy it just because it's closed lower than Friday? Why not buy it on the Wednesday because it's closed lower than the Tuesday type thing? You know, there's always anything that works on days of the week, I'm always a little bit skeptical of, because it's a theory that there's weekly cycles, but I've seen many times where weekly cycles just don't exist. They don't work. So I'm always skeptical about this type of strategy. However, I wanted to test it. And again, there you go. Friday, we didn't manage to close above the high of the previous day, so we're out. Yeah. So let that run. Equity curve looks pretty good. Yeah. Report made 43 grand, did 10 grand worth of drawdown. Looks good. Yeah. And this test is over, it's 2020 to 2024. So this is 2016 to 2024. So this is an 8-year test. So I basically did that, got the results out, but then I decided to change the test. And instead of using that result, I said, what happens if we close regardless of which day of the week it is, if the trade is in profit. So what my theory is if you buy, yeah, and the market pushes down, then it pushes up, and then it pushes down, on the Friday, you lose. Why not close out that day when there is actually some profit on the table? So the advantage is it removes those losing ones. All the trades that close on a Friday in a loss because it didn't manage to close above the high of the previous day, we make losses on. So if we can eliminate those by just saying, well, if we've got a profit, let's just take it anyway. That's what my extra filter was on the strategy, yeah? So you look at the results there. We made 43 grand on 10 grand's worth of drawdown. If you run my version of the strategy, we make 49 grand on 6 grand's worth of drawdown, 7 grand's worth of drawdown, yeah? So we made a little bit more money, and we took around about 30% less drawdown. Yeah, so I thought, well, we'll run that. So I ran all the tests. So what we got was the DAX made 45 grand, the Dow made 44, the NAS made 49, and the S&P made 103. Yeah, so looks good. Yeah, good high win rate, 73%, 81%, 84%, etc. But if you look at the individual profit curves on these, that's the DAX. Yeah. It's not great. Sorry, that made 4,500, the DAX. Yeah, so not 45 grand, that made 4,500. So it didn't actually make really much money at all. Yeah, it made a bit, but it's not particularly exciting as an equity curve. The Dow did okay, but only there. Didn't do much there, and hasn't done much since trade 130. Let me put the dates on. So it hasn't done much since 2022. So it had a lovely little run up, but that's it. 2021 to 2022, for 1 year, it made a lovely profit. The S&P, same sort of thing. We had a bit of a run up, but we're stagnating. We stagnated there. And the NASDAQ, pretty nice equity curve. Yeah, so it's got an edge in the NASDAQ. There's a 219-day period where it stagnated in the NASDAQ. Yeah, so 3/4 of a year. But yeah, NASDAQ, it looks good for. So it's one of those strategies, I think, it suits the NAS because they're tech stocks. Why does it suit the NAS? Because tech has been rallying for the last 10 years. All other markets, I think you're going to find stagnation in them, is going to be far too big. So looking at the S&P 500, yeah, it made profit, but for 554 days, it hasn't made any money. So these strategies, and this is partly why we do all of this, why I went through that whole week of robustness testing. Strategies look good on paper. You give somebody a strategy and you say, hey, look, in 8 years, this strategy made $10,000. They're like, really? Yeah, but you haven't made anything for 2 years. Oh. Yeah, so these strategies are good investment strategies. They're the sort of thing where you put in your pension fund and you let it run for 20 years and you're probably going to come out with a very nice, tidy return on it. But then again, if you just put it in the S&P 10 years ago, you got the same thing. No, there's no edge on the S&P. So this is the S&P superimposed behind here, look. Yeah, it's not a lot of difference. The NASDAQ has an edge now because it's tech. So this strategy, Alexander, if you're watching on replay, because you're probably not here because you haven't said hello. Yeah, it looks good, but it's a long-term investment strategy. The other problem with it is it took 161 trades in 8 years. So, you know, it's not the sort of thing you're going to be regularly making an income and a living from. This is just using 5 lots, right? So the drawdown is very, very small. It's got a great return to drawdown ratio. It's got a profit factor of 2.7, return to drawdown ratio of 9.9. Bloody good strategy. but 84% win rate. But you can't do this as a regular income-based strategy. It's a lovely long-term investment strategy. So looks good. It's the sort of thing that I would be happy to roll out on my pension fund, but not really something from an intraday perspective. The problem is it's only taking one trade a week, isn't it? And the other problem is it's not taking a trade every week. If Monday's close is above Friday's, you don't trade. If it does that for 4 weeks in the trot, you don't take a trade for an entire month. Yeah, so you have these whacking great gaps where it just doesn't trade. So it traded once in February, once in January there, twice in February, twice in March, twice in April, 3 times in April, sorry. Once in May, once in June, another time in June, once in July, once in August. Yeah, it's hard. It's not going to take that many trades. There in 2017, it traded in January once, then it didn't trade again until March. Missed one out. So there you go. So there's the results of that one. It's good strategy, but specifically good on the NASDAQ. If you put the Dow, the NASDAQ, and the S&P into a portfolio, you get 103k in 8 years. The one thing I would say about this, you can see the stagnation on the portfolio as well there, look. The stagnation on the portfolio is 554 days. So for the last couple of years, it's not been very good. But the one thing I would say is you've got this COVID in here where it made a 40k loss, right? And COVID only has happened once in our generation. So when you get these outlier events, there is an argument for removing them from the results. So you could say, actually, this made 140k, not 103. Yeah. But it did happen. So it's one of those, you kind of have to make a judgment call on it yourself type of scenarios, because if you remove COVID, the strategy is actually pretty damn good. But you can't remove COVID because it did happen in history, and there is nothing to say we're not going to get another one coming at some point. However, if we don't, or the market knows what to do in it next time, or rather you know what to do in it next time. Hey, there's rumor of a new pandemic coming from China. There's a load of people have died in XYZ. Turn it off. You would not experience that. When you turn it back on is up to you. But we now know that if there's any rumor of a pandemic coming anywhere, we know the markets are going to collapse. So you can preempt it now. You couldn't have preempted that. So there you go. So that's the results of that one. Pretty good strategy. Very pretty robust, but high stagnation. And the thing that I don't like about it is the vast majority of the profit was made there. Look. Yeah. So when you look at the overview on the portfolio, we've got 1 year that made 43 grand. Yeah. We've made 102 grand in the entire, sorry, it's 102? 103 grand in the entire 8-year test period, but pretty much 40% of that came in 1 year in 2022, the interest rate rally. Yeah. So, when you look at it actually on a year-on-year basis, you're looking at returning somewhere between 5 to 20k a year, which isn't, it's not to be sniffed at, is it? So it's pretty robust, but it's not going to set the world on fire. Morning, Harold. Linus, when scalping M5, mean that, do you even bother looking at higher time frame? No. When you're scalping, you're trade what you see. Yeah, we're trading price. We're scalping price action. Yeah, we're scalping what. Don't forget, a candlestick is a representation of price over time. We are trading what we are seeing happening now. I am seeing rejection at the highs. Yeah. At a previous rejection at the highs, a previous rejection of the highs. Yeah. I'm seeing rejection and price action telling me that we still can't get through this level and the bears are in control now. Yeah. This has nothing, this candlestick here has nothing to do with the 30-minute chart, the 1 hour chart, what happened today, yesterday, a moving average, any indicator. It's pure price action. You are trading what you are seeing on the chart right now is they can't get through that level. They've tried and they've rallied really hard. It looks like the exhaustion move is starting. That isn't a good price action signal. This is. Whether it works or not, though, is still 50-50, isn't it? But I've got advantage on my side that I know that they are selling this level. So although it's a 50-50, it's a 50-50 with backup. Think of it like a cop going to do a drug deal. If you're going to go and smash the door down on your own with a pistol, you're going to have a lot more chance if there's 10 blokes behind you with pistols, right? These are the guys behind us, the level. Yeah, this is what we covered yesterday. Increasing the probabilities by taking trades at logical areas that we can see that things have happened in the past and we are seeing signs of the same thing recurring. Still doesn't mean it's going to work, but we're just taking trades with a higher probability. Would it give an advantage if you had during the week positions, if you add during the week positions to the initial size? So you mean position trading into the strategy? You'd have to come up with a rule set for it. I'm just going to try and find one that was a loss. This is the thing with the strategy. The variation that I've made on the strategy gives a massively high strike rate, 80-odd%. But the problem when you take the losses, yeah, weekly, sometimes it just doesn't trade for weeks on end. Look, that trade there is 24th of June. Trade before it was the 15th of April. So 6 weeks, didn't take a trade. The problem is the losses are when you get the down weeks, the losses are big, and this is why the stagnation occurs. You'd have to have a rule that you'd need to come up with a rule for entering again. That trade's not right, is it? Why is that 8 days? 1, 2, 3, 4, 5, 6, 7, 8. That might be a... Why is that... We're getting out on a Friday. If that's a Monday, 25th of March... Hang on, let me just quickly check this. This might be a glitch in the system somewhere. 25th of March, 2024. It was a Monday. So that's correct. So the 25th, 26th, 27th, 28th, 28th. First, second, third, fourth, fifth. There's data missing. See, this is why strategy testing and robustness testing is important. That loss there, there's data missing here. And the only reason I spotted that was because that's more than 5 days. Monday, Tuesday, Wednesday, Thursday. So the exit would have actually been a break even on that one, not a loss. So we would have excluded that from the results. Let me just see. Everything else looks all right. So there's just a data issue there. I just want to find another loss. I won't use that one. This is the thing. It's a bloody good strategy, look. Yeah, I mean, it. Okay, there's another one. Third of March, 3rd of April, 4th, 5th, 6th, 7th, 10th. Ah, you know what this is? Okay, I know what this is. This is the market closing early. So in US indices, we have half-day closes on US bank holidays. So we do not get a 10:30 candle. We get a 4 p.m. candle. So this has actually done a position trade, hasn't it? But by accident. So this day where we should have been closing out at 10:30, right? The market closed at 1600. So we didn't get a 10:30 candle. So the actual trade in this particular case would have been there to there as a loss. Then the Monday would have closed above there, so that trade wouldn't have existed. Right, so this needs a little bit of tweaking, which will change the result. However, the amount of instances we're going to see like that are, it's bank holidays basically, isn't it? So I need to try and find an instance where we had a loss. There's one. Right, so I'll rerun this test again. I will put logic in to handle that. I'm just trying to think of how to handle it with logic. Just gonna have to use candle closes, I think, and ignore time, which won't give us a right representation of spread, but it doesn't really matter. So we got in there. Market immediately pushed against us on the Tuesday. So what we could do is say if Tuesday's close is below Monday's close, take a second trade. And then if Wednesday is in profit, get out. If Wednesday's close is below Tuesday's close, take another trade. If Thursday's close is in profit, etc., and do the same thing. Yeah. So that's what we basically need to do, wouldn't it? I can test that. But what you're going to find is you're going to take a trade, 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 and you're going to take 4 times the loss you would have done on a losing week, potentially. So it's whether or not position trading into it removes enough of the weekly losses and then it creates exponentially more loss. That's what we'll need to test. I'm just visually doing this because it's on a daily chart. It's quite easy to do, or on a 30-minute chart. So you'd have entered there. Averaged would be there. So you wouldn't have entered there. You wouldn't have entered there. Might have entered there, to be honest. You see, that would have also been a loss, but instead of 1 loss, you'd have taken 3 losses. So on these 2 instances I've looked at, we've got a 3x loss and a 4x loss. So we're taking 7 times more loss than we would, well, 5 losses in total instead of 7 losses in total instead of 5 losses. 2 losses. We're taking 5 extra losses. Ugh, sorry, Cloudy head because of cold. But that's only on instances where it works. See this one here, entry, entry, possibly entry, but even this one, so that would have been double win, possibly triple win. What you're going to find if we do that as a test, I think you're going to find is you're going to have more big ones of those, but you'll also have more big ones of those occasionally as well. So you'll probably find they equal each other out, maybe. We'll test it. I'll test it. Things like that, you're just going to take exponentially way more loss than you would have done if you'd just taken the one trade. You're taking more. It's how many times that happens versus how many times it does that. And this is the thing. The times it does the Tuesday, Wednesday reversal, you can't not make money. But in my looking at this visually, if it doesn't do that and it collapses, you're more likely to make a bigger loss, aren't you? I think on most of these occasions. There's another massive glitch, look. 22nd, 23rd, 24th. Market closed at 17:30 there. So we had a couple of days there over... Oh, it's Christmas. No, it's not. It's November. Sorry. We had a couple of days there where the market closed early. Okay, what I'm going to do, I'm going to rerun this because this data is clearly... the way that I've implemented the strategy is not right, is it? So what I'm going to do is, instead of using a close on Friday, I'm going to use a 5-day exit. So what I'm going to say... I'm going to reprogram the EA to say if the trade is 5 days old and we're at the close of the day, close the trade. Yeah, and then I'll also try and build in that scaling in. And the rule has got to be if the close is today is lower than the close of yesterday and there is a trade on, add another trade, basically, isn't it? Yeah. So it might work. It might help. So you got in a second position there. You'd have got in a third position there. You'd have been out there. So you'd have been that week, probably not a lot of difference. That week, definitely a massive win. Yeah, so it's going to be, it's going to be horses for courses, isn't it? That would have looked like that. Tick, tick, tick. Well, that's a cross anyway, but a tick and a cross is a tick. So yeah, looks pretty good. Yeah, I need to reprogram it. So I'll work on that. And rerun it. Being on indices, it's buy only, yeah. It's a buy only strategy. I tested it on sell and buy. Doesn't work. Yeah. And the reason it doesn't also work on the DAX is because the DAX doesn't trend like the US indices do. And specifically the NASDAQ. The NASDAQ is the biggest trender out of the lot, which is why it works a lot better on the NAS. It does work on the S&P and that. But yeah, there's issues there in the data and in the way the logic works. That's my fault because I didn't think about the early close. So yeah, I need to rerun that. Can you cover why you changed ADR to 60? Yes. So I'll do that now. It seems that I'll do that. That's the next thing we'll cover. It seems that some losing trades were closed early as well. There may have been days where the market didn't open. Possibly. Yeah, I don't know, I need to verify it. But this, I mean, this is what backtesting is. This is what it's all about. Yeah, robustness testing. You've got to check. Everything you do is only as good as the input. Garbage in, garbage out. If you stick garbage in, you get garbage out. However, I've stuck garbage in here and got roses, haven't I? It still makes money, even though I've cocked up the logic on it. And so sometimes it doesn't work. When it does work, it always works. So, you know, it's good when you get something wrong and make a load of money, because when you actually get it right, it might even have a much bigger edge. I might do it right and it's got a much worse edge. We'll find out. Does it make sense to take the positions similar to a logic as implemented in the SIHEA? Hedging? No, I wouldn't think so. You can't, because the SIHEA is a hedge EA, stock index hedge. This is a long only strategy. There is no shorts. You wouldn't want to take a short. Look at the strike rate. Yeah. The shorts don't work. The longs work. This is a long only strategy. I did do a test on long and short. And it was clearly a long bias. Yeah, there was way more long winners than short winners, and the short losers were quite bad. Yeah, when it goes into a trend, yeah, it goes into a trend. Yeah, so let's say, for example, you went short on one of these, basically. So if the close on Monday is above the close on Friday, you short it. The losses are very big because it has big up weeks. It's a stock index. It's manufactured and designed to do that. Yeah, obviously some weeks it will not, but look at that. I mean, you would have tried twice to short that in that month. Would have killed you. Right, ADR 60. So I did testing. Let's just quickly see how that trade's getting on. It's not going anywhere, is it? So for me, price action now, we got an inside bar followed by bullish price action creeping in, followed by an inside bar, an outside bar, slight bullish price action. Yeah, market's not going anywhere. But if we don't invalidate that high, we're still valid, aren't we? So, but as the trade hasn't worked, you could have in the last 15 odd minutes gone, screw it, I'll take it off. But the purpose of this is to get in and wait. That rejection isn't going to happen immediately. It's not, as much as you'd love it to, it's not just going to go down. It's going to muck about. That's what price does. So ADR 60. So I built an EA that exports. This is only on the euro US dollar. This one, you can test this on any FX pair, but it's the same result. Yeah. So what I'm looking at is with ADR and scaling into trades with the position trader EA, and in general with the market reversal alert CA as well. When you take trades, US dollar CAD is, I need to switch accounts again, 1 sec. So when you scale into trades, yeah, ADR is what the EA uses every time it gets into a trade. So it gets into a trade here, okay, and then it says, I am going to take my next entry, in this case, here, at 3/4 of an ADR, half an ADR, 1 ADR, whatever ADR you set, it goes, I'm going to take my next trade above that level from your previous trade. Yeah. So at the moment, ADR is 63. So that will be roughly 3/4 of that, which is 50 odd, 60 odd, something like that. 50 odd. No, not even that. Less than that, isn't it? 40 something. So it gets in and it scales you into those trades. Yeah, fine. That's no problem. The problem occurs when you get an expansion in price. So if price moves parabolic for multiple days with high ADR movement, the ADR 10 expands quickly. And then when price goes into accumulation with low volatility, ADR drops very quickly, ADR 10. Yeah. So what you find is when a move starts, if it exponentially increases in volume and speed and gets bigger and faster, what you're doing is instead of taking trades at the ADR you got in at, which is this risk, you're going to be taking trades further and further and further apart as that move continues, because the ADR number is increasing. The EA looks at the ADR 10. So if ADR 10 when you started was sitting at 63, and by the time you're in your fourth trade it's at 150, yeah, your spacing on your entries is more than double. Yeah, so you're saying I want to get in and I want to scale into this move, but we are now scaling in way bigger. Yeah, so what I did was I exported an EA. I built an EA just to export that data to show me what happens. So I've got it here. Make sure that's at the bottom. Yeah, I've got here. You can see every day basically what this EA does is it just exports what is ADR1, i.e. what was yesterday's daily range, ADR 5, ADR 10, ADR 20, ADR 60, 120 and 240. Yeah. And then I said, what's the minimum ADR and what's the maximum ADR and what is the average? Okay. So as you can see, ADR 1 daily price movement ranges from 18 pips in a day to 286. Obviously, some days it just doesn't go anywhere. Christmas. Yeah. Christmas, run up to Christmas, price doesn't move. Yeah. Interest rate decisions, we're parabolic. We're nuts, aren't we? Yeah. ADR 5 ranges from 33 to 176. ADR 10 from 39 to 161. So this is what I'm currently using. Yeah. So sometimes when I get into a trade, I might be getting in, let's say I use one ADR spacing between my trades. I might be using 39 pips between entries. Other days, I might be using 161 pips between entries. So if I get in on at the end of a grindy move and I take a trade short, and then the market goes parabolic against me, what I'm actually doing is spacing my entries not nice and neatly, but one of them will go in there, the next one will go in there, the next one will go in up there. The distancing between the entries is hugely different because the price of ADR, the size of ADR is exponentially increasing. But if you smooth that out with a higher ADR, the differential becomes smaller. So we're now looking at ADR 60. We've got a 49 minimum and a 125 maximum. So the differences are much, much smaller. So if we go through and just look at these columns, so this is every day what the ADR figure was. Yeah. So if we go through them, you see we're starting at 72 here on ADR 10. Within like the period of whatever this is, probably a month or two, there's not a lot of difference, is there? We're 70s. We went down to like mid to late 60s, back up into the early 70s, early 60s to 70s. Then we eventually jump up early 80s, but we're always hovering around the same area. But now look, hundreds, 136. So in the space of what's that? 14th of March to the beginning of March, which is there, we went from being 90 to 136. That's a 40% increase in ADR. Huge. But using ADR 60, we went from 75 to 83. That's less than 10 pips. Yeah. So the smoothing effect of using an ADR over a longer period, it still tells you roughly what the pip movement is of this instrument. Yeah. So it will calculate the lot size based roughly on what this thing does most of the time, but your spacing won't be so erratic, giving the system more chance to get closer trades so that these smaller pullbacks get you out faster. So That's why I was doing the research. 240, basically, you can see here, it just doesn't change. You're changing 1 pip, 2 pip, 3 pip, yeah? Whereas this thing is changing from 72 to 145. This is changing from 62 to 66. So you're not really getting any deviation. 240 is a year. So this is the yearly daily range, yearly average. Yeah. So I wanted to run the test to see what the differences are in them and see what impact it makes on spacing. Because what I want to do is I want to get the risk right based on roughly what the movement is. Yeah. And you see the average movement is the same pretty much using all measurements as it would be, because on average is going to move around about the same time all the time. But the extremes are hugely different. Yeah. Hugely different. And it's about picking a spot that's comfortable, because, you know, I don't know which one of these is the right one to use, but I want something fairly in the middle. So ADR 60 seemed to be the best one from a perspective of, and what I did was I wanted to find an area where we suddenly accelerated massively. And this is a good example, jumping from 83 to 136. So that region there, yeah. You can see, can't highlight it and keep it highlighted. Yeah. So you can see the difference there is vast, basically, isn't it? From 136, 138. But when we're doing that, it's a lot smaller. So we're moving sort of 10 odd pips there in that period of time, which is 1, 2, 3, 4, well, 62 to 79. So that's what, 15 days-ish, something like that. So a couple of weeks, 2 to 3 weeks, the distance that's changing from there to there. Instead of that, yeah, and it's not double, but it's not far off, is it? 80, that would be 160. We're at 136. So that's the reason I wanted to do it. And so I managed to get all this data out, and I tested it on Euro US dollar, I tested it on Pound US dollar, I tested it on US dollar Swiss, US dollar yen, and Aussie New Zealand, because that gives me a good indication of the nutty pairs like the yens and the Swisses, some US dollar crosses with the euro, the pound, and the US dollars crosses, and then the Aussie New Zealand testing the Australasian pairs to see what the variations are there. It comes out roughly the same, and it tells me that it smooths it a lot. That's the outcome of the test in general, and you can go through lots of things. But this chart here basically shows. I have to zoom out a little bit. The ADRs, and it's a chart basically that shows the numbers, if you like, are plotted on the chart. So with the data, I've removed ADR1 and ADR5. I'll put those back in. Where the hell's it gone? Oh, it's gone right back down there. So you can see when you put ADR1 and ADR5 in, it's this spiky thing. So ADR1 ranges from there all the way down to virtually not moving. So that's just ADR. That's just saying what was priced yesterday. So that's a useless measurement. ADR5 is far too quick. There's far too much volatility in there. Yeah. So I remove those. So we're looking at ADR 10, 20, 60, and I've put in there 120 and 240 as well. So these lines here are the really smooth ones, the 240, the 120. And this purple one here is the 60. So this 60 line has enough movement when we're going through periods of volatility, yeah, but it doesn't move ridiculously. So what I want to do is, when I get into my first entry, I want the initial risk to be calculated based roughly on what this thing moves. So we're going to get a very different reading on euro, pound to US dollar, yen, yeah. So that's going to be fine for an entry risk. But what I don't want to do is have my spacing blown apart when we get parabolic moves. And the problem with position trading, as every strategy has a problem, position trading's Achilles heel is parabolic squeezes. In parabolic squeezes, we need to be on the ball, and we need to be making sure that every tiny pullback we get an opportunity to exit on. When we get a parabolic squeeze using ADR 10, we space our positions further apart. The outcome of that is your position, we want to keep within ADR all the time so that when we get an ADR drop, we can exit the position. Your average position tends, when these parabolic moves happen, to get further and further and further away from price. So sometimes I'm sitting looking at a chart that's been taken with the market reversal alerts EA or the position trader EA, and this one's not too bad. It's 150. And the reason it's not too bad is because it's using ADR 60. But if I was using ADR 10 on that and this goes parabolic, I'd be sitting there going, I'm in 4 positions. Why on earth is my average 225 ADR away? It's because I haven't managed to get in to a trade in that space there because it's put it in 150 ADR away from the previous one. We've had price action in here, but the ADR distance, because this has gone parabolic for 2 or 3 days, it's now saying I should get you in at 31, but actually now I'm going to get you in at 65. Yeah, so I'm getting in later, which means my average moves up slower. If I'd have got in quicker, my average stays tighter to price. Getting in quicker also creates more drawdown, but I want to find a happy medium between the two. So that's the idea behind the research. So that's the outcome. So what I've done is I removed from the data the top ones, ADR 120 and 240, which is the 6 month and the yearly, which left me with ADR 10, 20 and 60, which is these ones here. So you can see the 10 is the green. That's what I've always historically used. And there's a massive volatility in it. Yeah. Look at that swing there from November to December 22. Sorry, October-ish. No? Yeah, that's right, no. So in a period of about 6 weeks, we were taking ADR at 160 and at 60. That's 100 pips difference. In a squeeze as well. That would have been a squeeze because ADR is expanding, volatility is expanding. Actually, that's probably COVID, isn't it? No, 2022, that's the interest rate rally. Yeah. So obviously volatility expands when interest rate rally rises start because we start getting more interest in investing in that particular currency. So, but what the ADR 60 would have done is moved from there to there. So it moves from 130 odd to 110. Yeah. So it means that when we're getting into our positions and market structure, when these movements are happening, is still going to do that. It means that these become more accessible as exits for us because our spacing is better when things are going more parabolic. Yeah. So that's the theory. So I've implemented ADR 60 for my entries. First of all, it doesn't impact entries. So the entry criteria on the position trader EA and the market reversal alerts EA is a condition based on RSI and reversal alert or moving average cross. So the only thing that changing from ADR 60 to from ADR 10 to ADR 60 affects from your initial entry is the lot size. And the lot size is still based on the average movement of the instrument. It's just over a slightly longer period. So what I'm finding is my initial entry is ever so slightly larger than it would have been with an ADR 10. But that is only true if it hasn't gone parabolic before my entry. Now, if it has gone parabolic before my entry, what I'm finding is my initial entry with ADR 10 is too small because it's gone, this thing's moving like crazy. Take a tiny lot. As soon as I get into it, it stops moving like crazy. So I find it very hard to make a decent amount of profit because I've taken a tiny lot size because of the previous movement in price. Previous movement in price has got nothing to do with what's going to happen within my trade I've just entered. So I want something that gets me in with roughly the same amount of money every time I take a trade. Yeah, so the deviation in lot size is smaller. So you're taking your first entries are roughly about the same size every time, regardless of what price has done here, because we're using 60 days worth of average, not the last 3. So imagine a price having a news event. So we got a nice, let's find a news event. Let's find the new, an Aussie pair, right? Tiny price movement, tiny price movement, tiny price movement, little bit bigger, parabolic. right? So an ADR 10 when I take a trade here, for example, on that day, takes that into account, this bigger movement, these days here, which are all roughly the same. Yeah. An ADR 60 smooths all of that out, so I don't get a much smaller lot size because I've got a much bigger ADR reading in the last 10 days. Yeah. So the difference is on the spreadsheet. Look. Whoops, where's it gone? So my ADR 60 measurement would have been on a 50 pip movement, or in the difference between it would have been a 50 pip movement or a 37 pip movement, or a 53 pip movement and a 115 pip movement. Look at the ADR there. That measurement there is caused by a huge spike in the market, a whipsaw, which immediately smoothed itself out. So think about the days where you get price that goes like that. You have a news event and an A-shaped recovery, and then we carry on. If you take trades on those days, your risk is more than half what you would have normally taken on it because of the news event. So it's filtering that out by giving a smoother reading on what your lot sizing should be and on what your spacing should be. So it's in forward testing at the moment, live. Yeah, because I don't think it's going to make a massive difference in normal trading. What I do think it might do is actually make exits quicker on normal scalps. But what I do think it's going to make a difference is in when we get a squeeze. And obviously the only way I can test this is to put this through a squeeze live. So we haven't had one. But so yeah, so that's the outcome of it, the testing. So if you take away the ADR 20 from this and just look at the two that I decided were the best as extremes, that's ADR 10 green and that's ADR 60 purple. So the deviation is just chalk and cheese. Yeah, here in normal trading conditions, your ADR 10 ranging from 39 to 63 there and ranging from 49 to 53 there, it's not massively different, is it? Sorry, those were the ADR 1s, weren't they, there I was looking at? Not the ADR 10s. But when you get these bigger movements, you know, you're going 20 pips difference, that sort of thing. So ignore that. When I was talking about those 140s, that was ADR 1s. But yeah, you can see the difference. So that was my findings. And as I said, I did it on all the other pairs as well. Not all the other pairs, but I did it on 5 other pairs just to get an average. So, gotta go, people. Okay, bye-bye. Watch the replay. Yeah, so there you go. So there's ADR. There you go. There's that trade. It's worked. Out. So everything we've discussed all week, trade taken based on everything we discussed all week, outcome, profit. Good, eh? Isn't it easy? But think about it. What were the odds of that trade panning out? 50%. I had a chance of it working, didn't I? So that's the ADR 10 research, ADR 60 research. So that's all I've done for the moment is I've flipped over to that. I did do a very quick test on something to try and see what the impact would be on the pound US dollar. And here's the results. So ADR 10, I don't even know what the test period was. What did I do? I did a 4-year test. So this is a strategy using the position trader EA over 4 years with whatever test criteria it was, which returned 3,600 profit using ADR 10. I then reran the exact same test using ADR 60 and it generated 12,000 profit. Yeah. But look at the differences between them. The strike rates are virtually the same because it's position trading. We got in and out of the same trades. Yeah. The difference comes in the drawdown. Yeah. So the drawdown using ADR 10 was $7,800. The drawdown using ADR 60 was 3,486. So using the higher ADR more than doubled the profit and reduced the drawdown by 50%. It took the same amount of trades, 73. So what it's meaning is we're getting into the same positions because we're only getting into the positions on RSI or ADR or whatever the criteria are. We're taking the same trades, but what we're able to do is take less drawdown and make more money out of them because the lot sizing is more consistent and the spacing is more consistent. So the thing that was concerning me about this, which hasn't proven itself in testing, is I was worried it was going to just turn into a grid trading system because obviously grid trading doesn't work. I've tested grid trading systems till the cows come home and they all blow accounts basically at some point. Basically it's like martingale. But because we have that criteria of only entering on strength, we do not get the same spacing. We get different spacing between entries all the time. Look at my US dollar CAD here and the spacing that we've got at the moment on it. Yeah, it's very different. So this is using ADR 60. So entry 1 to 2 is 40 pips. Entry 2 to 3 is 42 pips. Entry 3 to 4 is 65 pips. But it's not 65 pips because the measurement in ADR has gone through the roof. It's 65 pips because it just didn't give us any signals to go short here. Between the two of them, there just wasn't a short signal. Yeah, so we're still getting in on the strength when it comes in our way, in our favor. The market structure is changing, or we're seeing the price action move into our direction. But we are not getting in way further apart because ADR's gone up. So it makes a lot of difference. However, I need to properly forward test this and see it. I've done testing in the back tester visually. Obviously, I've done analysis in here on it. But, you know, it's things like size of trade look. So this is ADR 60. The first trade taken with ADR 60 has a lot size of 64.64 lots. With ADR 10, it was 58 lots. You see how the lot sizes are smaller because there might have been a run up there. That trade there was 29 on ADR 60. We got 123. So you're going to get a difference in lot size, but the lot size is much more consistent. If we look at an equity chart, probably better to make a portfolio of these two actually. Let's get rid of this, show the sub equities only. So yeah, there's the diff. Oh my God, what's that? Don't know what that is. What's that one? That's ADR 10. Look. Yeah, see, like ADR 10 would have taken a massive drawdown on the account for some reason there. Drawdown controls kicked in and done probably because the spacing was too far apart and it just took too much DD. But there's not a lot of difference generally in it. But whereas you can't do lot size individually, that's annoying. But you see the volumes, you can't actually see them, they're too small. I was going to try and show the volumes, but you can't really discern it. But you can see when I switch from ADR 10 to ADR 60, the lines get bigger, which means you are taking more lot size. Yeah, so ADR 60 gives you a bigger, consistent lot entry, which gives you a faster exit. Yeah, so we're mean reversion traders, so the faster exit is better for us on the whole. So yeah, I like it. So I'm running it and seeing what happens, but we will see. Don't forget the Q&A and the prop gap strat. Well, the whole thing's a Q&A, Harold. We're doing that. Somebody asked me to go through the ADR strategy, ADR analysis. I am answering that question. There we go. So yeah, that's that covered. Propulsion gap strategy. So let's use pound US dollar. Now, how is this working? The other thing I was testing with this, Harold, as well, this propulsion gap strategy, was working on bar close. So only taking exits and doing trading stops and things when the bar closes rather than on tick, which smooths the market out a little bit more. So I've been waiting all week for this. I don't expect me to do an awful lot here, Harold. The testing on multiple time frames is probably a 2 to 3 days work. I can't cover it in the live room. It's something that's going to need a lot of time invested in it. Yeah, so I'm trying to do this on control points and using higher time frames. I'm just going to reset this because I have no idea what this was doing. So I'm just going to reset it. So getting in propulsion trades, current ATR, let's use ATR 60 for a change. Propulsion is 25, targeting 1.5 R. I think that's it, isn't it? Time of day. We were going to use a time of day filter on this. That's what I was going to do. So I'm going to filter out Asia. And I'm only going to start trading from London. Only. I'm just trying this in forex, basically. Using higher time frames. So I'm just going to try and see if this works on hourly, basically, because the 5 minute and the 5 minute on indices and on forex, I just can't get an edge out of it with a trailing stop with anything. So for those of you who don't know, Harold and I have been talking in DMs about it, and I've shared the results I got, and they're not good. They're not bad though. They're just not profitable. But it's the sort of equity curve that looks like this. Yeah, when you get an equity curve that looks like that, there's an edge because it's not losing money. It's not winning, but there's an edge there that means that at some periods of time it does win. Yeah, but it has drawdown, and those are the bits where the market conditions are wrong. You've got to try and filter out if you can. I couldn't filter them out using trailing stops, using moving averages or anything. So I wanted to try and see if it's got more impact on higher time frames. So taking some trades here. So basically it's getting in, stop loss under the low, targeting 1.5 R. Getting in, stop under the low, stopped out. Getting in short, stop above the high, stopped out. Getting in long, 1.5 R, lovely. Same thing, stopped out on that one. Got in on that one, nice profit. Got in on that one, loss. Yeah, so it's working fine, but we're only looking to trade during times where these propulsion gaps have got something that makes sense. So on the pound US dollar, if you get a big move on the pound US dollar in Asia, it doesn't make sense. So news events, I think, is where this strategy is probably going to work the best. So when we get some high impact news that will either be held up and they will carry on adding into the high impact news, or it will be an A-shaped recovery, a load of rubbish, or a V-shaped recovery, a load of rubbish. Yeah. So it doesn't work on the open for indices either, Harold. I've tested it. That's the results I sent you. I tested those. Tested trading Nasdaq from 2:30 in the afternoon only. Just doesn't work on 5 minute time frame. You're trading algorithmic chop. This is the problem. Doesn't work long term. It does work short term, and you've proven it because you've said you've been trading it and making money with it, which is great. But you put it through a back test over 4 years. It has lovely periods where you'd be thinking this is the best thing since sliced bread, and then you go and it collapses. Have I got the equity curve? I can show. Yeah, so this is the equity curve I achieved. I'll have to put it in the browser. Yeah. So, you know, it has periods, you know. So if let's say, for example, this is Harold testing on 5 minutes right now for the last 4 weeks. It's like he's sitting there going, I'm telling you, this thing's the best thing since sliced bread. And I'm saying, yeah, I agree. It looks amazing. But if Harold started his test there and there, we wouldn't be having this conversation. Yeah. This is what robustness testing is about. Yes, it has short-term edges, which will make you a very nice amount of money over a short period of time. But there is an Achilles heel in the strategy where it just does not work long-term. Yeah. That's the robustness test on, what did I send you that on? 1 year NASDAQ. So this is the NASDAQ over a year on 5-minute time frame, only trading from the open until the end of the US session. Doesn't work. But, you know, the equity curves. So let's just let this run a little bit. See, you go up a time frame, and all of a sudden, this is price. You know, price. We talked all this week about price action. Price action on higher time frames is more orders. More orders is more confirmation and more faith in something. Yeah. But again, look, here we go. So this is, you know, this is a really good example of robustness testing and why I test so many strategies and dump them. Look at this equity curve. Started out at the beginning of this test looking amazing because the market was suited to propulsion moves and it was probably in some kind of trend. And then we hit a period where it went through indecision and balance and no trend. And then we got stuck in a rut for a while. Yeah. So if you did your testing here, you would go, this is the best thing ever. You would test it here and you would go, that's amazing. I'm going live. You would go live and you go, this is amazing. I've made a fortune. And then 6 months later, you'd be going, why is this not working anymore? Because you've got to test a 4-year period, at least on every strategy to make sure it's got robustness. Yeah. So it's got an edge sometimes. And what we need to figure out is why here? What was the market doing here differently to what it was doing here? And what is the market doing here and here? That's what needs to be done. But long term, obviously, there is times when propulsion moves work and there are times when propulsion moves don't work. So there is an edge there. So to remove this, we need a different exit strategy because the exit strategy of using a fixed risk reward isn't profitable. So what we can do is try to apply something to it to remove the losses. So these big losses that we sustain, let's see if a trailing stop can reduce those down. So I'm going to add a trailing stop based on ATR. So we'll go with a 2 ATR, I guess. So 2 times the average hourly movement. So if we move in profit, we'll suddenly start to reduce that risk. Yeah. So let's see what impact that has. Obviously, in the run up, we may find the run up actually gets smoothed out and isn't quite as big because trading stops will obviously get taken out when the market pulls against us. You know, this is a perfect example of prop. If you started a prop evaluation there, you killed it. Then you struggled, but you still made money. The next month, you blew that account and you started with the next evaluation. The next evaluation blew the account. Then you started with another evaluation. It went okay for a month or two. Then it blew the account. And then you started another evaluation. It looked like it was going good, but then it blew the account. This is prop. This is what happens in prop. This is why people get addicted to prop. You just keep going back, and sometimes it works, sometimes it doesn't, because the strategy is never going to last long term. You need a long-term strategy, and a long-term strategy is going to take drawdown. It just isn't one out there that doesn't do it. Not that I found, anyway. Nice little run up. But yeah, again, so trailing stop. Not great. Halfway through the test. So yeah. See, I mean, now we're getting back to a period of equity curves, market structures going long, looking good. But it's not losing a fortune, is it either? So training stop doesn't work. So let's try and remove that TP and see if we can get some big winners out of it and turn it into a breakout trend type strategy. So we'll remove the TPs. And just see if we can get out on a trail. And see if we can, when it's going to go more than 1.5 R, let's take that profit. Let the winners run. Not looking good either, is it? Not a lot of difference. Let me just switch accounts a minute. And test this on the indices. So let's do this on the NAS. And we'll need the timer filter at 1430. No, it's 1630. So we're only going to trade from 1630 onwards. So let's try that. We'll try it on the NASDAQ on the hourly time frame. See if we can get a result on the hourly time frame on the NASDAQ. Maybe let's go 15-minute first. Try going up one time frame. Let me just check this is actually trading correctly first. Yeah. Okay. Cool. Remove the stop loss and position trade the entries. We'll just use RSI or ADR then. Position trading doesn't matter how you get in, does it? It's a flip of a coin. So with your position trading strategies, if you get in here and make it a position trading strategy, just use one of the existing position trading strategies because they work. There's no point in building a completely new position trading strategy based on this candlestick. You might as well just use the other one, which is using an RSI or an ADR. Position trading works on mean reversion strategies, Harold. This is a breakout strategy. Yeah, your breakout's failing, you should have a stop. Breakout strategies aren't great for position trading. Position trading is about mean reversion. Downward spiral again. Look. Let me put this stop. Oh, I deleted stop losses, not take profits, you idiot. Wrong way around. I'm ill. No, hang on. What have I done? Did I do that right in the first place? Delete take profits after the trade is placed. Delete stop losses. No, I had it right. I had it right. Sorry. No, I had it right. It was deleting take profits. I was right. Okay. Let me go up to hourly. One sec. It's going to be a long day. But the additional entries are added on propulsion gaps at certain distances of ADR. Oh, I could do that, yeah, but you're creating an incredibly complex trading strategy. I already have two that are back tested over 10 years, Howard. Just use those. RSI and ADR work fine. But it won't work with this because it isn't position trading strategy, it's a breakout strategy. There we go. Still stagnation though. But now it's profitable. And the only change I've made is I've gone up to a time frame that is removing chop here. Still got problems, but then maybe reverse the entry to support gap fills and mean reversion. Yeah, but again, Howard, you're trying to reinvent the wheel here, I think, a little bit. Think about what these are. Propulsion gaps are big, strong moves in one direction. Yeah. What do you get normally when you get a big, strong move in one direction and a continuation? An ADR hit. Just short ADR. I mean, if that doesn't work, scale in. The thing with position trading EA is, the whole reason I made the position trading EA was because I specifically wanted speed of testing and buttons. Because I have proven, without a shadow of a doubt, you can basically tell me if your dog is a Chihuahua or a Rottweiler. And if it's a Chihuahua, I'll go long. If it's a Rottweiler, I'll go short. And I will make money. It doesn't matter how you get in. It's about the management of the position. So by turning this into a position trading strategy, first of all, you're trying to match a breakout strategy to a mean reversion strategy, which doesn't work. Secondly, it probably would work because all you're doing is flipping a coin. If my trade doesn't work, turn it into a position trade. Except what you're not using here with that approach is elastic band theory. And elastic band theory is what makes position trading work, because we are getting in after a strong move and taking profit on bank movement. What you are doing if you turn a propulsion gap into a mean reversion position trade is you are potentially getting in on the very first move of the bank, which could go on for weeks. We are getting in after the banks have gone for weeks or days or hours or whatever time frame. Yeah. So you're getting in when the banks are starting to stretch the elastic band on the breakout. We are getting in after the breakout has happened and they've stretched the market. Do you see what I mean? This doesn't suit position trading. It's a breakout stop loss based strategy, which should have an exit strategy typically of, if you're going to use it and turn it into a trailing stop and let it run, or a fixed R, which is small and you're taking a quick move. Same, it's breakout strategies are the same as trend strategies, and basically a propulsion move is a breakout move. That trailing stop might be a bit tight, but that turns it profitable. So all that's doing is hourly time frame. We're removing the TP and we're using a trailing stop of 2 ATR. That might be too tight, so I'm going to try a 4, a 2.5 and a 2. Just see, we'll use a bigger trailer. See if that, because what it might be doing is stopping out before it gets going. Sometimes it allows to capture the bigger moves as well. If the breakouts work. See, if a propulsion turns into a breakout, we want to stay with it. But you see that the smoothness of this equity curve compared to the other one, this is better for prop, because you either want to not blow or get the run. Whereas the other one, I mean, you are still going to get big drops. I mean, this is stop loss trading, yeah? It doesn't come without drawdown. Market conditions are not right. Market conditions are right. Yeah. Breakout trades won't work when it's doing that. Yeah. But when it's doing that, breakout trades are going to be beautiful. Yeah. There isn't a strategy you're not going to get this. This is much better. Much better. VT, does it make sense to use more propulsion gaps which are visible the same time in multiple time frames? Not really. If you think about what you're saying, let's say, for example, we use a propulsion gap on an H1 chart. Yeah. To achieve this, you have to have had a move on a lower time frame. So the move on the lower time frame to create a propulsion gap on a higher time frame must have strong movement on the lower time frame. And you can't look up, because to get a propulsion gap, you need the future to have happened. We've got to have a candle close ahead of the propulsion gap to form the propulsion gap. So you can't look into the future. You can only look into the past. I don't know. I don't think you'll find an H1 propulsion gap without one inside it. So let's look at yesterday. We had two propulsion gaps back to back there. Yeah, look, see that there's two propulsion gaps within that hour yesterday. Look at all these propulsion gaps. So to form a propulsion gap on a high time frame, you have to have propulsion gaps on a low time frame, because the lower time frame view creates the higher time frame view. So I think you'll find it will be hard not to have multi-time frame propulsion gaps in play. I don't think it's possible. I've never really looked at it, to be honest, but there we go. So that's a good strategy. So this is NAS prop. Where's it gone? Shut it. So look at all the losing months. Wow. Excuse me, sniffing. 4 losing months in a row. Losing year. 2 losing years in 8 years. 42% strike rate, because it's a trend strategy. Yeah, remember we've turned a breakout into a trend strategy because we've removed the TP, we've applied a trailing stop, so we've now turned this into a trailing stop based strategy, which means it's turned into a trend strategy, which means it's reduced its strike rate. Yeah, trending and breakout strategies 30 to 40%, mean reversion higher. So that's good. 3 grand drawdown. So 1-to-1 profit factor, 1.35 return drawdown. I mean, it's not going to set the world on fire, but this is just one variation of it. Hasn't worked for the last 3 years. Had a decent run up there. But think about this. This is the type of strategy, Harold, that you would employ in prop, because it has got a very good edge at times. Yeah. So, you know, if you look at this chart and think prop, that is a pass and a profit take. That whole period there was a loss. That was a pass and a profit take. That's a pass and a profit take. Loss, pass, profit take. Losing money all the time. Making money, losing, making, losing, making. In this period here, you would have had multiple past evaluations and withdrawals from a prop account, making a hell of a lot of money. Don't forget, the edge of prop is it costs you $500 to get 100 grand. When you withdraw, you make way more than $500. You'll be making 10 to 50. So it's as many losing evaluations as you can clock up and replace them with the withdrawals. So no point, not working at all. Probably worked there. Worked, didn't work, worked. So you've got periods where you would kill it in prop. Look at where the winners come. Between 1 to 8 days. So when you get the propulsion gap breakout, retest and go, you're holding these. That's where your winners come. These, it doesn't work because it's just mean reverting too quick. It's, you know, it's one of those strategies that's got an edge. But it kind of needs a lot of babysitting, which can quite often lead to curve fitting. You'll end up just squeezing the settings to suit the NASDAQ over the last 8 years. We don't know what the NASDAQ's going to do over the next 8 years. This is the thing. And it's single instrument specific. So if we test it on, let's test it on the S&P to give it a, let's test it on the Dow actually, and see what the equity curve is like on the Dow. And if we get a similar result, it means that it is going to work on indices, likelihood. But so a little bit of a ropey start, recovered. Not quite as good. We'll see how it runs. Bill, could you have a restriction, either minimum or maximum, on size of propulsion gap? You could do, but then you're curve fitting to data. You'd have to robustness test that to see what the deviation in the gap sizes is, and they'd all have to make money. The propulsion gap indicator has got a setting in it. So this is using a setting of 25, which is what Harold was using. So the candle has got to be bigger than any of the previous 25 candles. So we're looking for a big, strong move, a breakout, basically. It's all the propulsion gap indicator is a breakout indicator. It tells you when there's been a strong move in one direction, and it has to be bigger than the previous X number of moves. Yeah, so it's telling us that there's a big one. So when the market is contracted and small, you don't need such a big candle, but that candle is still, in relation to previous average daily range or ATR, much bigger. Therefore it is a big bank move, and therefore it is got a high probability of carrying on. Yeah. So measuring the size of it in relation to ADR, you are kind of already doing that with the standard setting in the indicator. So in mine, I use 0 because I just want to see every propulsion gap. So it's this setting here. Propulsion candle strength. I have mine just set to 0. So I just want to see every big candle that basically the wick of that one and the wick of that one, there's a distance of whatever. I don't care how big that is. If I set that to 25, this candle that creates the propulsion move has to be bigger than the previous 25 candles. So we're saying I want the strength of this to be bigger than the last 25x hours, 15 minutes, whatever it is. So I want to see a big, strong move, bigger than anything I've seen for 25 whatevers. So it's kind of got it built in. By setting it to 25, you are saying I need the size to be, but the actual size in distance related to the ADR, I don't think you'll find that will make an awful lot of difference, because this is a large order. So we're saying if there's a large order, carry on. It is a large order in comparison to previous order. It's high volume breakout. So I don't think it would make much difference. See, look, this it's a frustrating little strategy, because it does all right. So you've got these lovely periods, but you can't filter that out with anything. This is what this kind of tells you. This is what I'm looking here. Is there a way I can filter that out? And there's nothing really that stands out and says, I mean, as you would kind of expect, it kind of mimics the stock indices. So this is the S&P 500 in the background in grey, and it's kind of mimicking the S&P 500 in the fact that when it's trending strong, breaking out and continuing, this strategy works. It's a trend strategy, so it would work well when the market's trending. When the market is in a bear, it's not working well. I don't know. I'm finding it tricky to find a starting point to test from with it. I made a typo in my previous question. I wanted to ask was whether it makes sense to take propulsion gaps which are not only one time frame, but also for other time frame traders. I don't understand. Take propulsion gaps which are not only in one time frame visible, but also for other time. Oh, I've answered that, haven't I? Yeah. So yeah, no, I did understand the question, I think. What about increase prop gap strength to 60? We can do that. You're going to get a lot less trades. You're probably classifying these as really, they've got to be news breakouts to get this kind of strength. I think if you think about this strategy, yeah, if you look at what we are trading here, right, and I think this is part of the problem with it. You don't get in on these entries, and you can't get in on these entries until one candle after the move. So on an hourly time frame, for example, we get an hourly propulsion move, which is confirmed the following hour because that doesn't hit the high of that previous candle, creating that. So we are looking at a 3-hour price action move, which is a start of a move, a massive move, and then a confirmation that the move is still strong. So we're getting in after it's happened. Breakout strategies tend to be accumulation breaks, and they're much better if you take a break of the range. And that is where you make your money, on the ones that work, but you get in here, not here. I think the part of this is if we work if there's a continuation. If there's not a continuation, we don't. Look at most news events. Most news events, especially more recently, are a knee-jerk reaction, and they go, oh, actually, And we get a lot more A-shaped and V-shaped recovery news events. Look at the Aussie. We've had that. Am I on the right account? I don't even know which account I'm on. No, I'm in a different account. Oh, it's all over the place in this account. Aussie CAD. That's what I was looking for. Yeah. Interest rates. Back. Big move. Back. Yeah. So we're undoing. Can't see that. It's off the screen, isn't it? Moved it over too far. So yeah, we're undoing a lot of these big news moves at the moment, and we have been for a while. So the market's not going like that on news. It's going like that. Could try long only on them. Wow, it's rubbish. Not rubbish though, is it? It's all right sometimes. This is the problem. This is why I wanted to do these types of sessions, because this is all about strategy development. This job, if you like, doing whether you do it part-time, full-time, however you do it, it's about developing a way of getting into and out of the market. The whole premise of this working for you at any point in your life is going to be on developing a strategy that you can repeat and works. Robustness testing is the only way to do that. And this stops you spending too much time focusing on what doesn't work. So if you play around and you can just not find anything that's really got a solid edge on it, it's not, but it's understanding why it's not got a solid edge. So, go long only. I want to go back to the inputs I had before, which was working, which was 2, 1.5, and 1. So that was the one we used with a tight ADR stop, wasn't it? Tighter ADR trailer. So let's do long only and test that, because it's an index. It might be better that we only take propulsion moves in the way that that the market is actually headed, which makes sense. However, look at the year-long bear market we've just come out of. You've got a year there where you just don't trade. So it's, again, yes, it's potentially good to go long only, but also you've got to be prepared for not actually trading anymore, because the market's not doing that. Look at that winner. We just had a massive outlier there. It's just one massive profit just gone in there. Look at that, $1,700 profit. August 2020. You see, now you're looking at this and going, woo, we got profit. Yeah, weren't you lucky? Is that ever going to happen again? It's the new form of casinos. They're happy to take everyone's money. Yeah. And you can do it from home. EMA filters. I tested it with an EMA filter, directional wise. This is the same thing, isn't it? I mean, we know they go up. Didn't really work with an EMA filter. You can do it with an EMA filter. So basically what you're filtering out by going long only on indices is you're filtering out any positive US dollar news. We have had a lot of that because the indices would have gone down. So you're getting rid of those. But moving average trend filter. You're probably best to use the current time frame 20. So short term. No, you're not. You're not better using you're probably better using the 20. So what are we doing at the moment? Type filter. See, it has some lovely little run-ups, doesn't it? This is the thing. It has some lovely. It catches some really good trades, but it also just creates too many bad trades. This is using the 60 as well, not the 20. 25 rather. Strength. It catches that big move every time. Whatever that big move was, it's catching that. Kind of skews it a bit, doesn't it? You need to use a weaker filter, I think, on it. Don't know. Yeah, sack it off then. It's hard to let go of strategies, but I just can't find an edge in this one. I can't get it to. It's one of these. It's a frustrating one. I can see why you like it and why you found it, because it does. When I do any testing on any strategy, I find one of three things happens. There's really only three things that can happen, which is why I find them. But you either get a strategy which basically you find an idea somewhere, or you come up with an idea and you test it and it goes like that, and you're like, that's a stupid idea. And then you go, well, what if I did this to it? And it ends up going like that, and you think, no, that doesn't work either. Or you try a strategy and it goes like that, and you're like, that's too good to be true. And then you do a load of robustness testing on it and you find it still works. And then you do some analysis into why it works and you go, well, it's curve fit, or there's always something wrong with it, usually. Or the vast majority of the times, I find strategies like this. And you look at it and you go, well, that hasn't lost money. So it has an edge, because the edge plays out sometimes, but there's something wrong with it. And your job when you find this type of strategy is not to improve it. It's to remove as much of that as you can. Yeah. So if you can remove this, this, and this, you're left with that, not so much that, but, and that sort of price action. So and this is where the filtering comes in. So, okay, well, that looks really, really good. What if we just did that in line with a moving average, because it's a trending strategy? And all of a sudden you filter out half of that and it becomes a half decent equity curve. That's all you do. But you've got to make as many small changes to it as you can, as quickly as you can, because if you spend hours, days, and weeks trying to curve fit something to get profitable equity curves, you've done just that. You've spent too much time making this match the data. And then you get there and you go, that's brilliant. Let's go and test that on the 4 years before COVID. And the equity curve does that. And you're like, wasted all that time. So my initial tests, typically now, I tend to run my very first test over the whole 8 years pre-COVID and post-COVID. And if there's nothing there, I scrap it, because it's just not going to work long term. But you're not going to lose money. So what you would be is you'd be what they call a boom and bust trader. You'd be like, oh, like that. And you end up, when you're 60, going, I never made a penny doing this. And to be honest, I find it with 99% of stop loss based strategies, because that is what is happening, is you're using stops, which will stop out the winning trades before they occur. Screw it. For laughs, throw it on gold. Gold? I haven't got gold. I haven't got gold in this account. I've got a load of stocks on this account because I thought, I wonder if it'll work on individual stocks, and I tested that as well, but it didn't. Stocks gap too much. That's the trouble. 4 hour. I mean, admittedly, that worked, but it's only taken 22 trades over 8 years. So we'd need more trades than that. You know, the higher the time frame you go, the more investment strategy you become. The more investment strategy you become, the more likely it is to work. But it's an investment strategy, so it's for running your pension fund, not your daily income. So, yeah. Let me just quickly see. DAX is just dead today. Look, DAX stuck in that hedge. Can't get out. Oh, we missed a trade, guys. So if we'd have been our price action trading people, wouldn't we? We'd be watching this level again when it got back here. We'd have been seeing that indecision followed by indecision followed by bear. We would have taken a short there. We'd have had a stop loss, which would have been, that stop was there. So that stop would have been somewhere up here. And our TP, which was there, would have been a bit higher, about here. So that trade also would have worked today. Price action at support and resistance. Exactly what we covered yesterday. But I didn't take it because I was waffling. But yeah, there you go. Nice wick rejection, indecision candle, outside bar, indecision candle, bear, in. Took a bit of heat, but why did it work here? Because it worked here, here, the previous time we saw it, here, and here. What is that? An iceberg order. That is a bank or an institution sitting on 100 million or whatever amount of money at a price point going, give us all you got. I've got way more than you. You ain't getting through. And then there's a bank sitting down here with some amount of money going, yeah, bring it on. And you'll probably find it's Barclays, and it's the Barclays algorithm going ping pong and making money on every single trade that goes through the market today. That's what they do. They sit there and they just make buckets of cash. Thanks for trying anyway. Back to the drawing board. Yeah, I think it's one of those I've been playing around with it constantly, thinking, and I think it's one of those things I think about things at night when I'm going to sleep, and sometimes, unfortunately, I wake up in the middle of the night and it pops into my head and I'm like, that's not going anywhere for 2 hours, and I lie there thinking about it. And this is one of those strategies. I was like, I wonder if you could, and I tried it and it didn't. So I just can't quite get it there, and it's really annoying because it's my indicator. But I don't use it in this way. As you know, I use it for targeting because it's a very good targeting indicator. You watch me apply this to forex now again and it goes screaming up. Stagnates. Just doesn't make money. It doesn't quite make money. It doesn't quite lose money. It does make money. I mean, you know, it does make money. But the thing you've got to think about with strategies as well is you're going to be trading this. And this is one of the problems with the opening range breakout and the stock index hedge strategy. They are long-term hedges. But you will go through periods of pulling your hair out. And then you go through periods of, holy crap, this is brilliant. And the periods of pulling your hair out are where the market conditions aren't right. And you're waiting for the market to become right. Yeah, and you've got to sit through this and trade through this. And watching it go in here is fantastic, isn't it? But every single one of these lines we see flying past on our screen really quick is a day. Yeah, we've just gone 2 months, 3 months, 4 months. I'm sitting here not making money. I know it's coming. That's what you've got to sit through. And this type of strategy gives you an equity curve which is positive, would work as part of a portfolio of 10 strategies that are of a similar ilk. But it hits this horrible thing here for some reason. But yeah, just can't get it over the line. I'm not going to scrap it, but I did do a robustness test on it as well. I did a system parameter permutation test, and I got less than half the results coming out as positive, which tells me that with all the testing that I did I just basically tested stop loss, TP, yes to use a trailing stop, no to use a trailing stop. And I tested it on pound US dollar, not on index. Oh no, I did it on NASDAQ afterwards, because you said about NASDAQ. I did it on NASDAQ, and the robustness test came out with less than 50% robust. So I can't get it working. Right, well that's that all of stuff I wanted to cover today. So I don't know if you've got any other questions or anything. It's 11 o'clock. We've been here for a couple of hours, which is fine. But I didn't have anything exciting to do today apart from what we've done, because obviously we covered everything. And we also took a lovely price action trade, which made money, and we missed another lovely price action trade, which, looking at it, would also have made money. So that would have just TP'd us. So next week's plan, everybody who's watching these, are you, obviously I've been doing it now for 2 weeks. Is this the right format? Doing an hour a day, which is actually turning into 2 hours a day. I really want to try and keep it down to an hour a day if I can. Or would we be better off doing longer sessions or less times a week? I don't know what the best format is, so it'd be good to know what your sort of thoughts are. Because the other way I was thinking of doing this was, instead of doing a 9 o'clock session every day, was doing a session on 2 or 3 times a week, but then we go longer and we don't have a normal session. So I would just do normal lives 2 or 3 times a week as well. And I can squeeze a couple of afternoon sessions in maybe on the normal lives then. But I don't know what the best way to do them is. Shorter session is better. Yeah, okay. But yeah, I don't know what everybody's thoughts are, but I'm happy to do it anyway. So next week, zone out on longer ones, yeah. And these are longer. They're going on way longer than I want them to anyway. But I can't stop talking. So next week, I have no plan at the moment. So I've got loads of trader development streams planned to do with fundamental basics, how to approach trading as a business, reality of what you can earn sort of stuff, understanding probabilities of trading, which is going to be quite good, mathematics behind risk reward, focusing on your job as a trader, if you want to do it as a job. So kind of more the fundamental side of things. Other than that, it's indicator sessions and pretty much more of the same, trying to find some testing some strategies out, really, and trying to find some decent strategies that work. But most of the strategies that I find tend to be based on very similar things. So it's trying to find decent ones to use in scalping. And to be honest, price action at support and resistance is by far the best scalping strategy, but it's discretionary. And we can also just spend time trading, doing some trades, taking some trades, so higher time frames. you know, spending shorter sessions basically where we just go through all the pairs and come up with an idea to get into a trade. Yeah. So using a kind of a strategy that isn't a strategy type approach. So things like, for example, let's say we go through every chart every day and see if there's a way that we can squeeze a trade out of it type thing, which is how I always used to work. So I would look at, okay, if we push down into here and we see some price action on the hourly time frame, let's take a trade and put a quarter of an ADR stop on it. And just take it and trade it and see what happens. Because at the end of the day, it will or it won't bounce with the limits down here. And it's about trying to get some money out, that sort of stuff. So, but like VT's just said, trading live is very boring because most of the time we're sitting here doing nothing. That was a lucky one today. When I came over to the chart, we just happened to have a decent setup at resistance. But if we'd have come to the chart here, I would have said, okay, let's take a trade. And we would have been sitting here for 25 minutes. That would have gone too far. We would have missed that. 30. We would have been sitting here for maybe 45 minutes watching a chart. And that's the problem with trying to trade live. You can't just trade live. You have to wait for a setup. And if a setup doesn't come for an hour and a half, you ain't taking a trade. So it's a tricky one. And whatever works for you and your setup. Yeah. I don't mind. I can work anyway. I'm just doing trading. So I just sit here basically looking at charts and back testing all day long. That's really all I do. And then bits of pieces on the website as necessary. But that is me just waiting for money to appear, basically, is the job, isn't it? So I might do a bit of that where we just basically will go through an analysis and, you know, not trade a specific strategy, but come up with a strategy to trade based on what we see. So things like the pound Swiss, we're sitting here going, right, what's this doing at the moment? Well, it's kind of contracting. So let's apply a symmetrical triangle pattern strategy to this. Let's see what happens today. So if today we get up into this area here, it will be an idea to short it. Let's try that. So let's place a limit order up there. And then tomorrow we'll have a look at how that planned out. That sort of thing. But it's not, so it would be kind of an analysis session, I think, is what you would do when you say live price action trading. Because price action trading is literally, you can only make a decision once every candlestick. And we could trade them 1 minute charts, I suppose. But I mean, right now on the 1 minute chart on the DAX, I'm not interested unless we're doing something like this. Or if we get, you know, 3 long wicks appearing, might take a short and assume that market structure is going to be bearish. Outside bar, inside bar, outside bar. Sit, wait. It's not very exciting, is it? You don't really learn much watching price action do stuff like that. I don't know. But I'll have a think over the weekend and we'll come up with something for next week to cover. The other thing I was thinking of doing as well was more on position trading, because obviously I've got the position trading bootcamp out there. But if you want to have a week on position trading and the whole position trading methodology, why I do it, etc., kind of a more live interactive version, because it has changed a bit since the bootcamp, what I do, ADR 60 being a prime example. You know, stuff changes. So I was thinking about doing a session like that as well for a week or so. But we'll have a think. But I might put something in the members group, and obviously we can brainstorm on it, because at the end of the day, if the stuff that you want to do, that's, if everybody kind of wants to do the same sort of thing, then we'll do that. I can come up with ideas to the cows come home, but I don't want to sit here waffling about stuff you're not interested in. So that's really the key. All right, so I'll leave it there today. Anything else you need, let me know in Discord. I will be back on Monday for the normal streams, and obviously I will put up a schedule of what we're going to do next week, and then we'll do that. All right, might have a mixed week next week maybe, and doing all sorts of little different bits on different days. And again, any strategies that you've got ideas on, yeah, probably best to DM me rather than stick them in the Telegram, in the Discord channel. Otherwise, we're just going to have a load of strategy ideas in there, and everyone's going to run off and strategy hop, which is the norm. Right. Okay. Have a good weekend, everyone. Hope it's all good and good weather and stuff. And I will see you guys on Monday. Have a good weekend.